Hello, everybody, and welcome in to this week's episode of the Magnify Wealth Podcast. Here with your host, Scott Gannon.
Good day, everybody.
Today is going to be part one of a bit of a two-parter that we're doing. So part one, we're going to look at the risks people face during retirement. We're going to follow it up with part two on how we can actually enhance our retirement and get around these risks. But first of all, today we're going to look into the risks. So we're going to start off with market volatility. So Scott, you want to fill the viewers in on what market volatility actually means?
Yeah, so there's a total of 7 of these. So we're going to go through them one by one and have a little chat about each one. And the first one is, what is market volatility? Market volatility is, frankly, what you see almost every day in stock markets, is the ups and downs of the market. Now, what happens with the ups and downs? Sometimes they're quite significant, and the more significant that they are, the more they can affect the ultimate outcome going forward. So, like most people say, you will recover and so on, but this is kind of a non-starter when you're taking income, and this is what we're talking about there, during your passive income years or your retirement, which is the word we don't like to use. But anyway, so taking an income in a down market, in a downturn, like we've seen several times, it generally happens every 5 or 10 years, you actually magnify the losses when you're spending, because all you're spending is principal, so you're not spending any growth from your money. That can have a devastating effect to the fact of a huge lost opportunity cost that you can never recover from. And those losses, of course, like we talk about all the time with opportunity costs, are forever.
You hear a lot of people, say, like you said, you're in it for the long haul, and it doesn't really matter. But when you're in retirement and you're actually spending that money, it really does matter to the fact that 2 or 3 of these years can be the difference between having a legacy left over when you hit the grave and running out of money before you do.
Yeah, it's like one of our mentors always says is you always live until you don't, and when you don't, everybody likes to still have some money on the table.
You'd like money on the table until you don't as well.
Exactly.
So next up, we're going to talk about interest rates and how they actually can be a big risk in retirement.
Yeah, interest rates are a funny one because they can be a bit of a tug of war. And what I mean by that is when you're living off your money, you kind of hope for a higher interest rate. But if you understand everything we teach about how everything has a cost, you're financing everything, whether you're paying cash or financing. So those costs are higher when you have higher interest rates. So if you remember that you finance everything you buy and you still want higher interest rates, again, that there's a bit of a tug of war there, and interest rates, generally lower interest rates in retirement are usually not preferred, for the simple reason you tend to be spending more than you're financing. So interest rates can have a huge factor, especially when you're talking about the early years when most of your money is still there.
And next up is one that I think is going to be relatable to most people listening to this. Anyone that lives in a country, probably, and that's tax.
Yeah, so income tax obviously is a big factor in how your investments and or your sources of passive income are coming in. Are they coming in a tax-free manner? Are they coming in a tax-preferred manner? Are they coming in fully taxable? And all government benefits are fully taxable. They're just like their pensions. Pensions are fully taxable, just like your RSP is, because your RSP, by definition, is a personal pension. So every single dollar, whether you've lost money or gained money, is taxable. So the problem is we just don't know about where taxes will be. Now, what will they be? I don't know myself. Higher, probably. When you look at our debt, our government debt in Canada, and in Canada and the provinces for that matter, as well as the healthcare situation, there's a fair bit of money that we're still going backwards on. How much of your income and lifestyle do you want subject to that tax? Well, you have to be the judge of that. So speaking of healthcare, that's the next one.
Steal my thunder.
Go ahead.
Well, I mean, why don't you jump in here? Because I know you're not the world's biggest fan of where healthcare is at right now, are you?
The Canadian healthcare system? I am not. And I mean, obviously, and anybody that knows me, we've had some personal experience. Don't get me wrong, the people that work in our healthcare industry are awesome. And once you are in the system, if there's something wrong, you will, you'll get the care. At least that's the way it sits now. Problem is we have huge waiting times and so on, and those things aren't getting any better. So for all intents and purposes, our healthcare system is kind of broken. What will it look like in 5 years? I don't know. What about 15 years? What about 30 years? It just, what the current system we're on is frankly just not sustainable. So it's kind of one of those things that when we talk about healthcare, it's about making sure that you're ready for having to maybe fund this yourself.
Yeah, because at this point, there might be a decision to make whether they're going to even leave us any income left over to ourselves, or go toward a more privatized way of doing it.
Because style or that hybrid that everybody seems to argue about. That's probably where we're going to end up. And one other thing about healthcare is what the flow into that too is the long-term care aspect, where we have an aging population, and that is becoming more and more of a strain as well on the healthcare industry.
One of society's biggest scary future issues is the aging population.
Yeah, that's right, the aging population. So and hence, actually, that's how the government's trying to cure that, is with immigration, actually.
Yeah. All right, let's go on to the next topic, and that is inflation. Something that over the last couple of years we've all been quite privy to,
acutely aware of.
Yes.
Yeah, inflation is another unknown. It's obviously been higher the last couple of years. Will that persist? Well, who knows? But I suspect, we're looking for the kind of study that I've done is we've had compressed interest rates for over 2 decades before inflation kicked in, and those are kind of indicative. Interest rates tend to be higher in higher inflation environments. Is the interest rates going to come back down? They probably will, but generally speaking, we went through a 40-year decline in interest rates from 1980 to 2020. The 40 years before that, we were on a steady incline in interest rates. I don't know, that seems like a pattern. So to me, I'd be preparing for higher interest rates and higher inflation going forward. That's just me. But that's the cyclical, what we call cyclical bull and bear. Well, now it seems like we're kind of in the beginning stages of that uprise in interest rates, or what we call a cyclical bull of interest rates. So that's and again, inflation is cost of living, and that is the more inflation you have, the more income you need.
And you can tie that back into a previous point in tax too, and the inflation, all it's doing is bumping people up into new brackets as well, especially in their retirement when they might not have as much taxable income while they're hitting new brackets just because the number on the paper is higher.
Yeah, exactly. I mean, I don't. I know that the federal government's been, they finally started indexing this stuff with inflation. Is it matching? I doubt it. I haven't really tracked it completely, but I know here in Nova Scotia, where we are, we went over. I think it was pretty much a quarter of a century without any change. 25 years without any change in our provincial bracket. And everybody knows that I think things have been it cost a little more today than they did 25 years ago.
This year they were at least nice enough to index for 1 year of those 25.
Yeah, so we're starting our indexing now. We'll see how that goes.
All right, let's move on. Let's not try not to get a little too controversial here. Move on to.
We're gonna.
Here we go.
Yeah, we don't get controversial at all.
All right, government program changes. We'll let you take the lead here, and I'm gonna.
Yeah. So what that means is that's just a hidden way for governments to increase your tax. I mean, this is when we're talking about government programs, we're talking about retirement programs, we're talking about old age security to start with. Old age security is already income tested. Now the income is fairly high for people to get clawed back. And what clawback means is they basically pull back 15% of every dollar that you make in excess of that threshold. Now, the threshold for old age security, around $85,000 now per person. But there's another one that a lot of people don't even think about, and a lot of people don't even talk about because it really does hit a lot of people, and that is the age credit. What a lot of people don't understand in their tax return is there is an amount when you're age 65, you get, and the amount of the credit goes up the older you get. So once you're 75, it's higher than you are 65, in other words. And that credit starts to get clawed back in the past, I think it was 2023, it's $42,335.
I think that's actually this year.
That's the 2024, is it?
Pretty
So
sure.
that's 2024 number. So $42,335, you start getting a 15% clawback of your income. So is that a lot of money? I don't think so. Certainly, there's in retirement, do you want to be prosperous? Do you want to live in abundance, or do you want to live in scarcity? And really, this boils down to how much money do you want touching your tax return, because these things are tax return generated or tax return dictated. So meaning, if you can keep any of your cash flow off the tax return, that's going to only increase your chance. I'm not saying you'll get it, but it'll increase your chance of getting certain programs. And of course, mortality.
The biggest one.
The biggest one of all. Mortality, why mortality is the biggest one of all, or mortality is basically how long you're going to live. And it's the biggest one of all because the longer you live, the longer all of the other 6 factors come into play. Meaning inflation will be bigger. Return, you have a longer time to have market volatility. You have longer time to deal with healthcare or long-term care. So the longer you live, the more all those risks come into play. And the biggest fear retirees have, this is across North America, and this has been for years and years now, the number one fear retirees have is running out of money. Now, that doesn't need to happen if you structure your finances properly, or your retirement income or your passive income properly. If you get the right help and know how to do this, you can have an inevitable income that increases until you're gone, whether you live to 80, 90, 120, whatever. The key here is knowing that you're not going to rely necessarily on government programs. You're going to rely on being able to avoid tax and just keep up with inflation.
Awesome. The key here now is tune in next week, because next week is when we're really going to get into this, and we're going to talk about how those risks can be avoided. Because, it's all fine and dandy to be aware of them, but if you're just aware of them and they're going to hit you, well, you're not getting anywhere unless you're prepared.
Yeah. So yeah, we're going to show you ways that we can certainly reduce, depending on how much time you have, hopefully eliminate a lot of them, but for certain, we're going to be able to allow them to be less of an issue for you.
Tune in next week, guys. Thanks for tuning in to the Magnify Wealth Podcast.
Thank you very much.
Thanks for tuning in to the Magnify Wealth Podcast with Scott Gannon. Remember to subscribe on YouTube or your favorite podcast platform for more insights on the infinite banking concept. Until next time, remember, immediate action is the most efficient way to achieve your goals.